Greene of G Squared Private Wealth and Shannon Sakosha of SVB Private, both CNBC contributors. Ladies, welcome to the conversation. Shannon, to you first. Had some nice momentum, especially after Friday, into the afternoon, in fact, until Bostic said what he did and had us focusing once again on how far the Fed's going to go and what damage they might do along the way.
Certainly thought we were moving past this macro environment. I'm kidding, but that's what everybody was talking about when we came into January, right, Scott? We were all going to focus on fundamentals again. I think what the market is continuing to reflect is that they are under the impression that market participants play a relative game and the Fed is playing a relative game as well. And they are not. They are playing the absolute game. And so when you look at something like services PMI on Friday, 30 months of contraction. You think that the Fed is really all that interested in seeing one contraction figure from the services report? Hiring remains robust, and it's particularly robust in the services economy. Cameron just made a great point. That is going to continue to be a challenge for the Fed. And so while you take these data points that are potentially optimistic, like slowing wage growth on Friday, again, it's just relative to where we've been. And the Fed knows that that's still 2x what they really want to see for that figure. So I think it's going to be very difficult as we move into earnings season, because I do believe that it's going to be continuing to focus on what should the multiple of the market be, but most importantly, what companies are going to be able to drive earnings, because right now you can say that a company like Microsoft looks cheaper than it has been historically, but what is the correct absolute value for its multiple? I don't think we've actually reached that just yet.
Victoria, you want to decide where stocks are going. Maybe you need to bet on whether you believe in Bostic or the bond market, because Bostic can say whatever he does, right? Bond market says not so fast. It's not like rates ran away on that pronouncement by Bostic in any stretch, and the bond market has been signaling all along here that the Fed's not going to be able to do what it says. So maybe we shouldn't listen to them as closely as we are.
Yeah, and that's the disconnect, like you guys were talking about earlier, what the Fed fund futures are pricing in, which is obviously some cuts in 2023, and what the Fed is saying. I do think they're a little embarrassed about the transitory problem that they had last year, 2 years ago now. So I do think there's a lot of pressure on them to stay the course. They're pounding the table, listen to us, the market has it wrong. And that's always a bit of a dangerous time to be an investor if the Fed is telling you the markets have it wrong. And if you look at the signals, they just don't look great. And I know everybody's bearish. It's like in vogue to be bearish now, but it's hard not to be when you have 130 basis points between the 6-month and the 10-year. That inversion's never happened without a recession. So right now, robust job market. We'll see what happens with earnings. You know, we're actually cautiously optimistic it's not going to be terrible, and the hurdle is now a little bit lower for earnings. But for me and where the market goes right now, I am actually listening to the Fed, because that mantra you got to repeat to yourself is don't fight the Fed, and the Fed is telling you the market has it wrong right now.
Well, it's one thing what they're telling you. We need to see what they're actually doing. Of course, if they actually follow through, it would be prudent to not fight the Fed. But if they're all bluster and then less on the action side, then maybe it does pay to go against history and actually fight the Fed. What's interesting, Victoria, Cameron says to sell the rips. You're actually looking to buy the dips, and you've been fairly negative in the market. So you're looking for opportunity after a while?
I do. I think the end of the world is not going to happen. Yes, we're seeing some seismic shifts in the world with deglobalization and what's happening with all the global geopolitical kind of crises we're in. But I see a bottom in the first half of this year. So if we had something like happened in November, where we had that kind of, or I'm sorry, in the end of the year, in December, when we had the markets fall off before it rallied out, I'm looking to start adding capital to these dips, because I do think we're going to get better in the second half. So I'm not a seller of the rips. I am looking to add money to the markets when the markets go down, because I'm, again, listening to our core tenet, buy low, sell high. I do think there's a lot of companies that have been fairly beaten up. I think you're going to see a weaker U.S. dollar. You saw the dollar kind of barely holding on to that long-term trend around 103. If it can't hold 103, that's a lot of downside to the dollar, which might be a huge pickup for multinationals that saw a lot of currency headwinds. So for me, I am looking at positives. As an investor, you are having to be optimistic that it will eventually get better. I'm not calling a bottom yet. We see that more around 3,400 area. But at this point also, if we see those nasty pullbacks like we got over the fall, then I want to be adding capital, because I see an improvement coming in the second half of the year.